If you were born before 1960, there is something important you should know before assuming that you've already received every tax benefit available to you as a Canadian senior. There are CRA forms that can potentially unlock valuable tax treatment for eligible Canadians, yet many people never complete them simply because they assume the rules don't apply to them. But here's the part that could save you from making a costly mistake. Being born before 1960 does not by itself qualify you for a special CRA form or tax credit. And that's exactly why this video matters. One form that seniors frequently hear about is the Disability Tax Credit Certificate, Form T 2201. Another is Form T 1032, the joint election to split pension income, which can be particularly important for eligible couples receiving pension income. These are very different programs with very different eligibility rules. So today we're going to separate fact from internet headlines and explain what Canadian seniors should actually know. We'll look at who may qualify, what the forms do, why some seniors rule themselves out too quickly, what documentation can matter, and the mistakes you should avoid before submitting anything to the Canada Revenue Agency. And stay with me because later we'll discuss a tax strategy involving spouses that many retirees don't investigate until it's too late to make the decision they wanted for that tax year. If you want straightforward information about Canadian retirement benefits, CRA rules, CPP, OAS, GIS, and senior finances without the confusing jargon, subscribe to the channel and turn on notifications. Let's get started. First, let's clear up the biggest misconception. You may have seen headlines suggesting that Canadians born before a certain year can access a special free CRA form simply because of their age. That's not how Canada's tax system works. There is no general CRA form that becomes available simply because you were born before 1960. Your age can matter for certain credits, pensions, and tax rules, but age alone does not automatically establish eligibility for the disability tax credit, and it does not automatically create a tax refund. This distinction is incredibly important. The form we're going to discuss first is Form T 2201, Disability Tax Credit Certificate. The Disability Tax Credit, commonly called the DTC, is designed for people with severe and prolonged impairments in physical or mental functions who meet the CRA's eligibility requirements. The application involves information from the person applying and certification from an appropriate medical practitioner. According to the CRA, applicants can apply at any time during the year. The CRA also provides both digital and paper application options. So why is this particularly relevant to seniors? Because aging and disability are not the same thing. A person can be 70, 80, or 90 and not qualify for the DTC. At the same time, another senior may have a qualifying impairment and could potentially be eligible. That means the right question isn't, was I born before 1960? The better question is, do I meet the CRA's disability tax credit eligibility requirements? And that difference can completely change how you approach your tax return. Let's talk about what Form T 2201 actually does. Form T 2201 is the Disability Tax Credit Certificate. It is used to apply for the disability tax credit. The CRA requires the impairment and its effects to be certified by an appropriate medical practitioner. Depending on the type of impairment, different practitioners may be able to certify the application. The CRA lists medical doctors and nurse practitioners among those who can certify impairments generally, while other professionals may certify specific types of impairments within their areas of practice. This is one reason seniors should not simply look at their age and decide they aren't eligible. The CRA focuses on the effects of the impairment and the qualifying criteria rather than simply asking whether someone has a diagnosis or has reached a certain age. And there's another important point. The DTC is a non-refundable tax credit. That means it can reduce federal income tax otherwise payable, but unused amounts are not simply handed to you as a cash payment. The CRA states that if the person with the impairment does not need the full disability amount to reduce their tax, an unused amount may potentially be transferred to a supporting family member who meets the applicable conditions. This can be particularly relevant in families where one spouse has little taxable income but the other spouse provides financial support. However, this does not mean every senior with medical expenses qualifies. That's another common mistake. Having arthritis, diabetes, hearing problems, mobility problems, vision problems, or another medical condition does not automatically mean the DTC will be approved. The CRA looks at the effects of the impairment and whether the statutory criteria are met. So don't treat the DTC as an automatic senior benefit. Treat it as a tax credit with specific eligibility rules. Now let's make this practical. Imagine a Canadian retiree named Robert. Robert is 68 years old. He receives CPP, OAS, and withdrawals from a registered retirement account. He also has some mobility difficulties. Robert sees a headline saying, "Born before 1960, file this CRA form." He downloads Form T 2201, but then he thinks, I'm probably too old for this, or perhaps he thinks everyone over 65 qualifies. Both assumptions could be wrong. Robert's age doesn't automatically qualify him, but his actual functional limitations might be relevant. The important question is whether his impairment and its effects meet the CRA's requirements. Now consider another example. Mary is 72. She has several medical conditions, but they don't necessarily create the level or duration of impairment required under the DTC rules. Simply having multiple diagnoses doesn't automatically mean she qualifies, so Mary shouldn't assume that a form guarantees a tax credit. She should review the official eligibility requirements and, if appropriate, discuss the functional limitations with a qualified medical practitioner. This distinction is especially important because seniors often hear phrases like tax credit, government benefit, refund, and CRA form, used as though they all mean the same thing. They don't. A tax credit is not necessarily a monthly government payment. A CRA form is not necessarily an application for CPP or OAS. And being eligible to submit a form does not guarantee that the CRA will approve it. That brings us to another important opportunity for retired Canadians. And this one has nothing to do with disability. If you're married or living common law and one spouse has substantially more eligible pension income than the other, there's another CRA form worth understanding. It's Form T1032, Joint Election to Split Pension Income. This is not the disability tax credit form. It is a completely different tax mechanism. The CRA says eligible couples can elect to split certain pension income, with up to 50% of eligible pension income potentially allocated to the other spouse or common law partner. Both partners must make the joint election. Why could this matter? Because retirement income isn't always distributed evenly between spouses. Let's imagine one spouse receives $50,000 of eligible pension income while the other receives $15,000. Depending on their circumstances, pension income splitting could potentially shift some eligible pension income for tax purposes. The purpose isn't necessarily to create more total household income. Instead, it can change how taxable pension income is allocated between spouses. And that can sometimes affect the couple's overall tax situation, but there are important conditions. The CRA explains that the spouses or common law partners generally must have been residents of Canada on December 31 of the tax year, and they cannot have been living separate and apart because of a relationship breakdown for the specified period. The income itself must also qualify under the pension splitting rules. So once again, this is not an automatic benefit for everyone over 65, and this is where many seniors make a mistake. They hear that pension splitting exists and assume every type of pension can simply be divided in half. That's not correct. The income has to qualify. The couple has to meet the applicable conditions, and the election has to be completed correctly. The CRA says the transferring spouse reports the full eligible pension income and claims the elected split amount as a deduction, while the receiving spouse reports the transferred amount. So if you're a retired couple, don't simply ask whether pension splitting sounds good. Compare the tax result under the applicable rules. And remember that changing the amount elected in a later year may be possible because you don't necessarily have to use the same percentage every year. Let's return to the title of this video. Why mention people born before 1960? Because that group is now largely within the traditional senior retirement age population, and many of these Canadians are receiving CPP, OAS, workplace pensions, RRIF income, or other retirement income. But there is a danger in making age the entire story. Age can help identify the audience. It does not replace the eligibility rules. For example, the CRA's pension income rules can depend on the type of income you received, not simply whether you are 65. The CRA's tax guide explains that certain pension and retirement amounts qualify for different reporting and pension income treatment, depending on the type of payment. This is why seniors should look at their actual tax slips. If you receive a T4A, T4RFF, T4RSP, T4AP, T5, or other tax information slip, don't just look at the total amount. Look at what the payment actually represents. That information can determine how it is reported and whether a particular tax rule applies. And there's a second reason to pay attention. Some tax credits are based on income, others depend on age, others depend on disability or medical circumstances, others depend on family relationships, and some involve elections between spouses. These categories shouldn't be mixed together. Now let's talk about something that may be more relevant to many seniors than they realize: medical expenses. The CRA allows eligible medical expenses to be claimed under the applicable rules. For the 2025 tax year, the CRA explains that eligible medical expenses can generally be claimed for expenses paid in a qualifying 12-month period ending in the tax year, provided they weren't already claimed for the previous year. This matters because retirees often pay for expenses that aren't completely covered by provincial health insurance or private plans. But again, not every expense qualifies, and you should never assume that because something relates to your health, it automatically belongs on your tax return. The CRA maintains a list of eligible medical expenses and explains documentation requirements. You generally don't send receipts with your tax return, but you should keep the supporting documentation in case the CRA requests it later. This is a simple habit that can save a lot of frustration. Keep your receipts, keep prescriptions where required, keep certifications when required, and keep records organized by tax year. Don't wait until the CRA asks for documentation to discover that you've lost everything. Here's one of the most damaging habits I see in retirement tax discussions. A senior sees a complicated government form and immediately says, "That's probably not for me." This can be understandable, but refusing to investigate eligibility is different from being ineligible. If you think a particular credit or election may apply to your situation, check the official CRA requirements. Don't let the form itself scare you away. At the same time, don't go to the opposite extreme and assume that completing a form guarantees money. Neither approach is safe. The correct approach is understand the eligibility rules, determine whether your circumstances fit, collect the required documentation, submit the form correctly, then wait for the CRA's determination. That sounds simple, but it is much safer than relying on a viral headline. Now let's talk about timing. For most individual Canadians, the tax filing deadline is an important annual date, but certain elections and applications can have their own rules. For pension splitting, the CRA explains that the joint election must generally be completed and filed by the applicable filing deadline, although under certain circumstances, the CRA may permit a late or amended election. That means you shouldn't wait until the last possible moment if you're considering pension splitting. Review your tax information early, look at both spouses' income, check what pension income qualifies, then determine whether an election could make sense. For the disability tax credit, the timing is different. The CRA says you may apply at any time during the year. However, if you submit the DTC application together with your tax return, the assessment of the return may be delayed because the CRA needs to review the DTC application first. That's an important practical detail. If you're considering the DTC, you may want to deal with the application ahead of your tax filing rather than waiting until the last minute. And don't forget that medical practitioner involvement may take time. Your doctor or other qualified practitioner may need to provide information about your impairment and its effects. So don't assume this is a 5-minute process. Plan ahead. Let's go through some of the biggest mistakes. The first is believing that your birth year automatically qualifies you for the DTC. It doesn't. Your birth year may identify you as part of the senior population, but the DTC has its own eligibility criteria. The second mistake is confusing the DTC with a monthly benefit. The disability tax credit is a tax credit. It isn't the same thing as CPP, OAS, or GIS. The third mistake is assuming every medical condition qualifies. It doesn't. The CRA evaluates the impairment and its effects under the applicable rules. The fourth mistake is assuming pension splitting means you can split CPP or OAS however you want. Don't make that assumption. Pension splitting has specific rules about what pension income qualifies. The fifth mistake is filing without keeping documentation. Receipts, tax slips, medical certifications, and other supporting records can become important if the CRA reviews your claim. The sixth mistake is assuming that because your spouse has low income, pension splitting will automatically be beneficial. It may be, but you should actually compare the tax consequences. And finally, one of the biggest mistakes is relying entirely on social media videos for tax decisions. That includes this video. Use videos like this to understand the issue. Then verify your personal circumstances against the current CRA rules or speak with a qualified Canadian tax professional. If you're finding this information useful, take a second to subscribe. This channel is focused specifically on Canadian seniors, retirees, CPP, OAS, GIS, CRA rules, retirement income, and government programs. And because these rules can change, staying informed can be just as important as understanding the rules themselves. Now let's move to the practical part. What should you actually do if you're watching this and wondering whether one of these forms applies to you? Step 1 is simple. Gather your recent tax documents. Don't start with the form. Start with your financial information. Look at your income slips. Look at your pension income. Look at your RRIF or registered plan withdrawals. Look at other taxable income. Then look at your medical expenses if applicable. Once you understand the income picture, you can begin asking the right questions. If you are considering the disability tax credit, review the official CRA eligibility information. If your impairment may qualify, discuss the functional effects with an appropriate medical practitioner. The CRA says the application can be completed digitally or on paper, and Part A and Part B must be submitted using the same method. That's an easy detail to overlook. Next, if you're married or living common law, look at your household income as a couple. Don't only look at your own tax return. Compare both returns. If one spouse has significantly more eligible pension income, investigate whether pension income splitting could apply. The CRA says up to 50% of eligible pension income can potentially be allocated to the other spouse or common law partner, subject to the rules. And here's an important strategy. Don't assume you have to make the same pension splitting election every year. Your circumstances can change. One spouse may have a different amount of pension income. One spouse may have withdrawals from a registered account. One spouse may have changed employment or retirement status. So reassess each tax year. Let's imagine a hypothetical couple named David and Susan. David has substantially more eligible pension income than Susan. Susan has much lower taxable income. They've never looked into pension income splitting because they assumed it was only for wealthy retirees. That's a mistake. Pension splitting isn't exclusively a strategy for wealthy households. It is a tax rule that may be relevant to eligible couples with qualifying pension income. Now imagine a different couple. One spouse has a qualifying disability and very little taxable income. The other spouse provides financial support. In that situation, the DTC rules concerning transfer of an unused disability amount may potentially become relevant if the CRA approves the application and the applicable conditions are satisfied. Notice the pattern. The opportunity isn't created by the person's birth year. It comes from the person's actual circumstances. That is the lesson I want you to remember. Don't download a random CRA-looking form from an unofficial website. Go directly to the CRA's website. Don't pay someone simply because they promise guaranteed approval. There are no legitimate shortcuts around eligibility. Don't exaggerate medical conditions. Don't ask a medical practitioner to certify something that isn't accurate. And don't assume that because another senior received a tax credit, you automatically qualify too. Every person's circumstances can be different. Your income can be different. Your medical situation can be different. Your marital status can be different. Your province or territory can be different, and those differences can matter. The safest approach is accurate information and proper documentation. So let's come back to the headline. Born before 1960, that is a useful way to identify today's audience. But it is not an automatic qualification rule for the disability tax credit. If you're 65 or older, don't automatically assume you qualify, and don't automatically assume you don't. Check the actual rules. If you have a severe and prolonged impairment that may meet the DTC requirements, investigate Form T 2201. If you're part of a couple with qualifying pension income, investigate Form T 1032 and pension income splitting. If you have significant eligible medical expenses, review the CRA's medical expense rules. And if you receive CPP, OAS, GIS, workplace pensions, RRIF withdrawals, or other retirement income, make sure you're reporting and reviewing that income correctly. The goal isn't to chase every possible tax form. The goal is to avoid leaving legitimate opportunities unexplored. Let's summarize everything. First, there is no general CRA form that automatically gives a tax benefit simply because you were born before 19. Second, Form T 2201, the Disability Tax Credit Certificate, is important for Canadians whose impairment may meet the CRA's disability tax credit requirements. Age alone does not establish eligibility. Third, the DTC is a tax credit, not the same thing as a monthly CPP, OAS, or GIS payment. The CRA explains that an unused disability amount may, in appropriate circumstances, be transferred to a supporting family member. Fourth, Form T 1032 can be important for eligible couples who want to make a joint election to split qualifying pension income. The election can potentially allocate up to 50% of eligible pension income to the other spouse or common law partner, subject to the rules. Fifth, medical expenses can also matter. Keep your receipts and supporting documents because the CRA may ask for them later. And finally, don't let a confusing form or a viral headline make the decision for you. If you are eligible, you want to know. If you're not eligible, you want to know that too. The important thing is making the decision based on the actual CRA rules rather than assumptions. Powerful ending. If you were born before 1960, the most important thing you can take away from this video isn't that you automatically qualify for some secret CRA benefit. It's actually more useful than that. It's this: don't rule yourself out before you check the rules. A lot of seniors do exactly that. They see a complicated form. They assume it doesn't apply, they don't investigate, and years later they discover that their circumstances were worth discussing after all. But the opposite mistake can be just as serious. Don't assume you're entitled to a credit simply because you're a senior. Don't assume a form guarantees money, and don't rely on a headline to determine your eligibility. Look at your actual circumstances. Look at your income. Look at your medical situation if relevant. Look at your spouse's income if you're a couple. Look at the official CRA requirements. And keep your records. The Canada Revenue Agency provides the official rules and application information, so that's where you should go before making an important tax decision. Your retirement income matters, your taxes matter, and even small misunderstandings can have a meaningful effect on a household budget over time. So before your next tax return, take a fresh look at the credits, deductions, elections, and forms that may apply to your actual situation. And remember, your age can be relevant, but your circumstances determine eligibility. If this video helped you understand the difference, subscribe to the channel for more straightforward Canadian senior updates covering CRA, CPP, OAS, GIS, retirement income, and government benefits. Turn on notifications so you don't miss the next update. And most importantly, stay informed, because when it comes to retirement finances, the best time to understand your options is before you need them.